Imagine telling a traditional Wall Street fund manager, like 5 years ago, that a military drone strike in the Middle East and an Elon Musk aerospace launch would completely dictate the price of their digital assets. Like, they would have laughed you right out of the room.
Oh, absolutely. They would have thought you were completely crazy.
Mhm.
But, well, here we are.
All right, here we are. Welcome to another edition of The Week That Was. We are taking a deep dive into some recent financial digests today to figure out exactly what is, actually driving the markets right now.
Yeah, and if you're prepping for a board meeting or managing your own portfolio, or honestly, if you are just insanely curious about how money actually moves around the globe, you are in exactly the right place.
Exactly.
Yeah.
Okay, let's unpack this. Because our mission today is to untangle a truly chaotic week of global capital rotation.
It really was chaotic. I mean, we're looking at a massive stack of data here, and the big overarching theme is just undeniable.
Yeah, for a long time there was this prevailing narrative that digital assets operated on an isolated island.
Right, the idea that crypto was somehow decoupled from the gravitational pull of traditional finance.
But I think it is safe to say that illusion is officially shattered now, right?
Completely shattered. I mean, the data we're looking at proves irrefutably that these markets are now hypersensitive to traditional global shocks. The walls are just down.
Crypto is just another neighborhood in the global macro city.
Exactly. And when the weather changes, every single neighborhood feels it.
And the immediate trigger for this whole sequence of events actually started with the weather changing over in Asia. Like, we saw a severe, localized stock market crash in South Korea.
Yeah, it was brutal.
I want to hand this over to you because the numbers here are just staggering. What exactly happened with the KOSPI index?
Well, the tech-heavy KSPI plunged 8.29%. And to put that in perspective, Samsung alone was down 10.2% just in a very short window.
Wow.
Yeah, it was a really violent sell-off.
So if you are listening to this and looking at your digital asset portfolio, you might be wondering, what does a South Korean semiconductor sell-off have to do with the price of Bitcoin? Like, connect those dots for us.
Right, it's a fair question. It really just comes down to liquidity and margin. Retail investors, particularly in regions with massive digital asset adoption like South Korea, they don't have infinite money.
Right. They're pulling from the same finite pot of speculative capital.
Exactly. So when they face a massive sudden drawdown in their traditional equity portfolios, like their Samsung shares just tanking their capital, gets completely locked up.
Because they're getting margin called by their traditional brokers.
Yep. The broker basically says, your stock portfolio just dropped 10%, you need to deposit more cash right now, or we sell your assets.
Oh, wow.
So to meet those margin calls, or honestly just to hold on to losing positions without going bankrupt, these retail traders are forced to liquidate whatever else they can.
Which means dumping their crypto.
Right. Instantly, the discretionary funds they would normally use to buy the dip in digital assets just evaporates. They become forced sellers of crypto just to save their traditional stock portfolios.
That is a brutal domino effect.
Yeah.
But I mean, it wasn't just Asia draining the pool. At the exact same time, geopolitical friction flared up in the Middle East.
Yeah, the military action in the Strait of Hormuz.
Right. I was looking at the energy sector digests, and that immediately led to a significant spike in crude oil prices.
A 3% spike, precisely. And, an energy shock like that does not stay contained to the Middle East. It cascades directly into the U.S. domestic economy.
Which explains the inflation numbers. We saw the headline, Consumer Price Index, the CPI, hit 4.2%.
Yeah, and if you look under the hood of that specific data release, energy costs specifically surged 23.5%.
That is massive. And because of that high inflation, the Federal Reserve is now projected to keep interest rates high.
Right, they're holding them in a restrictive range, which effectively starves all risk markets of liquidity. But wait, I have to stop you there. Because we have been told for a decade that Bitcoin is digital gold, like the ultimate hedge against inflation. So why is it behaving like a fragile tech stock the second inflation actually kicks up? Make that make sense.
That is the million-dollar question, isn't it? To understand why this happens, we really have to look at the mechanics of systematic fund managers.
Okay.
These are massive institutional players, and they're driven entirely by quantitative algorithms. They do not trade based on the philosophical narrative of a digital asset.
So they aren't reading the white papers.
Not at all. They don't care about the digital gold marketing. They trade based purely on its statistical mathematical behavior.
So they are just looking at volatility metrics.
Exactly. Right now, those algorithms categorize Bitcoin as a high beta risk asset. It is highly liquid and highly volatile.
Right.
So when a macroeconomic panic hits like an inflation spike driven by an energy shock, those algorithms are programmed to automatically liquidate highly liquid assets.
Just to cover their traditional equity losses. Right. Or simply to move into cash until the dust settles.
So right now, trading algorithms are treating Bitcoin less like a safe haven bunker and more like a thermometer in the wrong room, like just dumping it like overvalued semiconductor stocks the second inflation spiked.
That is a perfect analogy. The algorithm doesn't care what the thermometer is made of, it just reacts to the temperature reading. If the macro temperature gets too hot, the algorithm hits the sell button across the board.
Wow. So the macro environment drained the retail pool.
Yeah.
That explains the initial weakness. But it really doesn't explain the absolute cratering of the spot ETF that we saw later in the week.
No, it doesn't.
You were looking at the institutional data, and the real culprit for the massive liquidity drain wasn't fear. It was actually FOMO, fear of missing out in the aerospace sector.
Yeah, if we connect this to the bigger picture, we really see the sheer scale of modern capital rotation and how completely asset classes overlap now.
Let's talk about the SpaceX Initial Public Offering. I know you have the exact figures from their filing. What were the numbers on this launch?
It was a generational capital event. They priced the IPO at $135 a share, and they raised an unprecedented $75 billion.
Insane.
Yeah, giving the company a valuation of $1.77 trillion. But the demand is what truly broke the market plumbing.
Because everyone wanted in.
Exactly. The IPO was 4 times oversubscribed. It pulled in over $150 billion in total bids from institutional managers.
Okay, so clearly everyone on Wall Street wanted a piece of Elon Musk's space empire. But again, how does a rocket company going public drain the crypto market?
This is where the concept of opportunity cost becomes the defining factor of the week. Asset managers have a strict fiduciary duty to generate the highest possible returns for their clients.
Right.
So when a historic growth opportunity like the SpaceX IPO occurs, every single fund manager scrambles for an allocation. But to buy those shares, you need fiat cash. You need US dollars.
And Bitcoin is incredibly easy to liquidate.
Precisely. Asset managers weren't selling Bitcoin because the network failed or because the cryptography was broken. They sold it because it settles instantly, and they need cash by Friday.
So Bitcoin became an involuntary liquidity donor.
Exactly. They were chasing explosive yields in aerospace, and crypto was basically the ATM they used to fund the purchase.
And we definitely saw the receipts for this ATM withdrawal. Like, this scramble for cash triggered a massive 13-day streak of ETF outflows.
It was heavy.
In just 1 week, $1.72 billion exited the U.S. spot Bitcoin ETF complex. And BlackRock's IBIT fund took the absolute heaviest hit during that exit.
Which perfectly illustrates how fully integrated digital assets are into the traditional plumbing of Wall Street now.
But okay, the irony here is just incredible. I was reading through the SpaceX IPO paperwork, their S-1 filing, and it reveals a brilliant paradox. Can you explain what SpaceX actually holds on its corporate balance sheet?
It is genuinely funny when you map it out. So SpaceX holds 18,712 physical Bitcoin on its own corporate balance sheet.
Right. So Wall Street sold massive amounts of Bitcoin, crashing the price, to raise the cash to buy SpaceX.
Which inadvertently gave them exposure to over $1 billion worth of Bitcoin anyway.
It is a beautifully absurd loop. You have traditional finance managers accidentally building shadow crypto portfolios through tech equities.
Yeah, they sell the asset to buy the company that holds the asset. It really highlights the circular nature of modern corporate treasuries.
Okay, here's where it gets really interesting, though. With all these TradFi managers scrambling for cash, publicly traded companies that already hold massive amounts of crypto had to make hard choices about their own treasuries.
Right, and we saw 4 completely different playbooks unfold this week regarding how corporations manage their digital assets.
Let's break those down, because if you are looking at your own portfolio right now, you might be asking whether you should be holding tight, selling, or buying more.
And what's fascinating is that the biggest corporate players in the world cannot even agree on the answer. The psychology is totally fracturing.
So first, you have the accumulators. These are the true believers who just never stop buying. But how are they actually financing this? Like, what did Strategy Inc. do?
So Strategy Inc. executed a classic stock dilution. They sold shares of their own company to the public to raise $181 million in cash.
Wow.
And then they turned right around and used that cash to buy another 1,550 Bitcoin.
They are relentlessly adding to their stack, no matter the macro weather.
Exactly. And similarly, we saw an AI data center firm called Hyperscale Data Mandate that all of their treasury cash must go into Bitcoin to serve as collateral.
So that is the maximum accumulation, never sell strategy.
Yeah.
But then we saw a fascinating counter move, which I love. The trolls.
Ah, yes. Strive Inc. They went into the open market and bought exactly 32 Bitcoin, not 31, not 33.
And they did it using pure cash, right?
Pure cash without taking on a single cent of debt.
And that highly specific number was meant to cheekily mock Strategy Inc., wasn't it? Because Strategy Inc. actually had to sell exactly 32 Bitcoin the previous week to cover some operational costs.
It was a very public, debt-free flex.
I love the corporate theater.
It is highly entertaining, certainly. But the third category is the one with the most profound long-term implications, the search for yield.
Right, the yield chasers. We saw a company called BitMine pivot hard. They bought $214 million worth of Ethereum.
But they didn't just buy it to hold it in cold storage.
Right. They bought it specifically to stake it for network yields. They explicitly rejected the dormant asset model of just holding Bitcoin and hoping the price goes up. Why is yield suddenly so crucial for these treasuries?
It comes back to the macro environment we discussed earlier, high interest rates.
Okay.
Companies are realizing they cannot just hold assets that do nothing on the balance sheet, especially not in an environment where the cost of capital is sitting near 4%.
So explain that for the listener. What does it actually mean to lose money against the cost of capital?
Well, think of it this way. If you can put your money in a risk-free government bond and earn 4% interest, then any asset you hold that pays 0% is technically costing you money in lost opportunity.
Oh, I see.
So staking Ethereum provides a native cash flow, a yield that helps offset that cost of capital. They're treating digital assets like productive software, not just, gold bars in a vault.
Which brings us to the final group, the debt reducers. Nakamoto Inc. actually went the opposite direction and liquidated 600 Bitcoin into the open market.
They did.
And they didn't do it to buy a different asset. Why did they sell?
They did it to pay down high-interest debt they owed to Kraken. By doing so, they avoided the risk of getting margin called if the market dropped further.
So it's a masterclass in risk management.
Exactly. They sacrificed a portion of their holdings to ensure the structural survival of the broader treasury.
So we have accumulators diluting stock, trolls buying with pure cash, yield chasers staking Ethereum, and risk managers paying down debt. This desire for yield, for security, for structural integrity, it isn't just changing how corporate treasuries behave.
No, it's changing everything.
It is causing traditional Wall Street giants to completely rewire the infrastructure of digital assets. Wall Street isn't just visiting the crypto casino anymore. They are actively ripping out the floorboards and installing their own slot machines.
That is exactly what's happening. And by slot machines, we mean highly regulated, compliance-friendly instruments. They don't want to play at the decentralized tables. They want to own the house. Let's look at BlackRock.
Right. BlackRock filed for a new covered call ETF under the ticker BITA. How does this actually work mechanically?
Okay, so a covered call. Imagine you own a house and you get paid a premium, like a cash fee, by promising someone they can buy it from you at a specific higher price a month from now. If the price doesn't go up, you keep the house and the cash fee. So BlackRock's BT fund will hold Bitcoin, but it will systematically sell options against that Bitcoin to generate a fiat dividend for institutional investors.
Wait, so it generates a yield in US dollars without ever having to touch decentralized finance?
Exactly. From an institutional compliance standpoint, that is a total game changer. A traditional pension fund manager cannot easily interact with a decentralized, unregulated lending protocol. The compliance department would have a heart attack.
Right, of course.
But they can absolutely buy a BlackRock ETF that pays a structured fiat dividend.
And the traditional players are aggressively moving into the derivative space, too. I saw a regulated prediction market called Kalshi launched perpetual futures for XRP.
Yeah, they did.
For the listener who might only buy spot assets, what is a perpetual future and why is this a big deal?
Well, perpetual futures are essentially betting contracts on the price of an asset that never expire. You can hold the position open indefinitely as long as you pay a funding rate. Historically, almost all of that massive derivatives trading volume lived on unregulated offshore exchanges, We are talking about a $90 trillion offshore market.
And Kelshi is attacking that directly.
Yes. By bringing it onshore within a regulated U.S. framework and using a zero-fee promotional structure, they allow massive institutional capital to finally participate.
Because institutions want the leverage of perpetual futures, but they need the legal safety of a regulated platform.
Exactly. Kalshi is building that bridge.
Even the plumbing of the tokens themselves is changing. I saw that Circle launched CirBTC on Ethereum to aggressively challenge BitGo's monopoly on wrapped Bitcoin, and Circle is utilizing automated proof of reserve.
Which is vital for institutional trust.
How does that work?
Instead of relying on a periodic audit by an accounting firm, automated proof of reserve uses smart contracts to mathematically prove in real time that every wrapped token is backed one-to-one by actual Bitcoin.
Oh, so it just removes human error and counterparty risk entirely. The convergence between traditional finance and crypto is just undeniable at this point.
It really is. If you look at the options volume right now, it is rapidly converging between traditional finance and crypto-native platforms.
Right.
What that means structurally is that Wall Street hours, the standard 9-to-5 trading day now, have just as much influence on global prices as the offshore markets that operate 24/7. The center of gravity is actively shifting to New York and Chicago.
So after all the macro shocks, the Chaos PI crash, the SpaceX vacuum, and Wall Street entirely rewiring the plumbing, where did the market actually land at the end of the week?
Well, despite the immense selling pressure we talked about, the underlying market structure held.
It found a floor right near $59,000, right?
Yeah.
And I was reading that institutional buyers, specifically UAE family offices, aggressively stepped in at that level.
They did. They clearly viewed that sudden drop as a pricing inefficiency to exploit, rather than a fundamental failure of the asset.
And that institutional floor provided the exact foundation needed for a massive short squeeze.
It really did.
Explain the mechanics of that bounce, because it was violent.
Right. So when traders bet heavily that the price will continue to fall, they open short positions, they borrow the asset and sell it, hoping to buy it back cheaper later.
Okay.
But if the price hits a floor, like those UAE family offices buying at $59,000 and it begins to rise, those short sellers start losing money fast. Eventually, their brokers force them to buy the asset back at market price to cover their positions.
And we saw over $504 million in bearish bets get liquidated.
Right. And all those liquidations trigger forced automated buy orders. That cascading buying pressure is what drove the price rapidly back above $63,000.
So it was driven entirely by market mechanics and forced covering, rather than a slow, steady accumulation by retail buyers.
Exactly.
But the institutional flows did eventually reverse too. The massive streak of ETF outflows we talked about earlier finally ended, flipping back to an $85.85 million net inflow by the end of the digest period.
Which, this raises an important question. What is the actual state of the market beneath all this surface-level volatility?
Yeah, because if you look at retail sentiment indexes during the crash, they were flashing extreme fear. Retail investors were panicking.
But look at what the institutions are doing. Wall Street is building ETFs, Kalshi is building regulated derivatives, and Circle is building proof of reserve tokens.
The underlying infrastructure is quietly being cemented by the world's largest financial and tech entities, while everyone else is distracted by the price.
Exactly.
And while everyone was watching those price charts, some massive technological shifts were happening completely under the radar. MasterCard unveiled its Agent Pay for Machines platform. This is wild.
It really is.
It allows autonomous AI software to settle microtransactions natively, using stablecoins and blockchain rails, completely independent of human input.
It is the absolute beginning of true machine-to-machine commerce. Think about it mechanically. Traditional credit card rails are too expensive, too slow, and too heavily gated for an AI agent that needs to make 10,000 microtransactions a second to buy data or server space.
Right. The fees would be astronomical.
Exactly. Blockchain infrastructure is genuinely the only logical settlement layer for that future.
And as we look to that AI-driven future, we also saw the door firmly close on the past. Sam Bankman-Fried had his appeal denied by the courts this week, and he formally applied for a presidential pardon.
Wow.
It really feels like the closing of a chapter on that volatile, unregulated legacy crypto era, making way for this highly regulated, institutionalized future we've been tracking today.
The contrast is striking. I mean, legacy actors are exhausting their final legal appeals from a jail cell, while the future of the industry is being built by BlackRock, MasterCard, and autonomous AI agents.
It really is. So To summarize what we have covered, this wasn't just a week of crypto volatility. It was a masterclass in how deeply entangled digital assets have become with global inflation, corporate debt, and the traditional tech sector.
Oh, absolutely.
From South Korean semiconductor crashes forcing retail margin calls to Middle Eastern oil spikes triggering algorithmic sell-offs and massive aerospace IPOs draining liquidity for fiat, everything is connected.
The boundaries between asset classes have completely dissolved. Crypto is macro, and macro is crypto.
So, what does this all mean? We spent all week talking about how human hedge fund managers and human retail investors reacted to this market. But looking at MasterCard's new AI payment rails, you have to wonder, 5 years from now, will the biggest players moving liquidity in these markets even be human? Or will we be tracking the trading habits of autonomous software agents?
It's a fascinating prospect to consider as the infrastructure matures. The algorithms already trigger the sell-off. Soon they might be the ones holding the wallets.
Definitely something to keep in mind as we watch these markets evolve. Thank you for joining us for this deep dive. We will catch you on the next edition of The Week That Was.